Hi guys, welcome to another episode, and we're going to talk about real estate today. That's one of our hot topics, and that is not just our hot topics. It's just a hot topic anytime during the year. And also, like we always say, we encourage you to be in the real estate business, become a real estate investor. And we're going to talk about something very interesting. We all know that people come up with a lot of rules, right? The so and so's this rule, so and so's that rule. And we're going to talk about something that you heard time and time again in the real estate world. If you're going to be a real estate investor, meaning that you're going to be owning several real estate properties, and your plan, of course, is to rent them out. And this rule that we always hear is a 1% rule. So we're gonna take a deep look at this 1% rule and see whether actually it works, whether it makes sense in this world. So my friend is on the other side, and then let's talk about it.
Yeah. So first, let's define what's 1% rule is. Like,
Correct.
if you guys, I know most of you know about what's 1% rule, but let's talk about what is 1% rule. Just to start with,
Yeah.
the 1% rule in real estate has been kind of established among the investors, like you said, right? Like, for example, you're buying a house for $200,000. Your rent has to be like $2,000. 1% of the sale price of the house, you should have it as a rental income.
Right.
That is kind of that's a rule. But think about it'll work on definitely, because we have been in this real estate investment business for a while. So we have seen it. It doesn't work on everything. That's what we wanted to advise you guys today. Like 1% rule may work on $100,000 house. Like you're buying a condo,
Right.
$100,000 condo. It's pretty easy to rent it for $1,000.
Correct.
Especially in a university area.
And
Uh,
if the and also if the townhouse is a new townhouse, good area, yes, that's possible.
Yeah, $1,000, close to $1,000, right? That's close to 1%. But if let's, for example, $2,000 house, at least in
You
our
mean a two
area,
hundred thousand dollar house?
yeah, you don't even have $200,000 in your area.
Right.
So even my area, like we have $200,000 house. You cannot rent it for $2,000. None of them. You can rent it for 1,400, maybe 1,400, maybe 1,500 maximum. That's it, right? It's not one. It's not 1%.
It's
Definitely,
not even close to 1%.
right? It's not even close to 1%. So, for example, if you believe in, like, you are a newbie and you are trying to invest in, and these guys are coming up with this 1% rule, it's like a blanket rule. They just said, oh, if it's not 1%, it's not a good deal. It doesn't work like that.
Yeah.
So in this case, you have to bring in a lot of other things to it, right? So for example, $200,000 house you're buying, monthly rent is $1,500. Your mortgage is, let's say, it's going to be around $1,000 to $1,100. So you are going to get $400, $300, $400 cash flow per month. If you put 20 to 25% down payment, right? So you need to think in that sense and then see how much cash on cash return. If
Yeah.
you're getting, like, let's calculate it, right? $400 every month you're getting, right? $400 cash flow every month, because you're only paying, everything included is $1,100. 400 times, so you have to do 400 times 12. That's like
48.
$4,800 in the whole year cash flow, right? And then let's say you put 25%. What is 25% of 200,000? 50,000, right?
50,000. Yeah.
50,000. So 4,800 divided by 50,000.
Mm.
That's like a 9.6% return on your money.
On your investment. Yeah.
It's almost close to 10%. This is just on the money, right? Think about tax benefit. Think about you're going to climb the interest. You're going to climb the property tax. So this is actually, I would say it's a good deal, because anything above 8% return, like, you are going to get 7%, close to 7-8% in the stock investment, right?
Right.
Average. You may get more, 20, 30, but it's like, you may lose money too, right? I'm talking about average. It's like around 7%, 7 to 8%. So this is more than that. On top of that, you're getting other benefits to it, right? So anything above 8%, if you're getting on your return on your cash, it's a good deal.
So our whole topic, the beginning, we talk about the 1% rule and this kind of have a good look at it whether it makes sense or not. But it sounds like more than that whole 1% rule. Let's focus on the 8% from your investment, right? So we are talking about 8% from your 8% from your initial investment on a property. That may be a more doable or feasible kind of goal than the old school 1%
Right.
method.
Yeah, like 8% your return, right? We are talking about ROI, return on investment. So you put it in the stock one side, you would get around 7 to 8% for sure. But it's not for sure. Like you have to select the stock properly, right?
Yeah,
It may go down completely and wipe out. You won't have any
yeah.
money. But if you have real estate, at least you are going to definitely, you're getting in this case 8%, 9.6%. So it's above the 8%. That you should definitely go for it. It's a good deal.
And if you completely forget about the percentage, right?
Right.
Percentage from this, percentage of that, as a ballpark figure, if you have a townhouse, or if you know, let's say if you have a single family house and you want to rent it out, what would be just this ballpark figure? What could be the ideal dollar amount per month you should look for?
Yeah.
Forgetting
So
about all.
like think about you have you put $50,000 in that deal, right? Your money. Like you need to think about how much money you have in the bank. Like if you're not invested, kept it in the
Mm,
bank. You like what you're doing. It depends on what you're doing. Like basically, if you take that 50,000, not do anything on it, just kept it in the bank, you're going to get nothing, maybe $1
yeah,
at the end of
yeah,
the year, right? And then you do it in real estate here. In this case, you get $4,800, right? And then you do it in maybe stock. If you get lucky, you may get around 3,500 around that, right?
right.
So think about like that. That's one way to assess all the opportunities out there, right? But another one, like you said, like how much cash flow is a good thing for you. Like at least I would say anything like $100,000 investment, right? You are buying a house for $100,000. I would say at least $100 to $200 cash flow per month, right? And then 100 to 100 and 100, let's say 100 to 200,000.
Mhm.
I would say 200 to $400 per month cash flow. And it's just a ballpark.
Yeah,
It's not like we have to bring in a lot of other numbers, right?
right, right,
But
right.
100, anything below 100, he should get 100 to $200 per month, because you need to take care of a lot of other expenses.
Yeah.
And then anything up between 100 to 200, it's like 200 to 400. And then anything 200 to 300, I would say 400 to $600.
Right.
And anything about 300, you should be able to get close to 600, 600 to 800 or above.
And the other factors, some of the other factors that you might have to think about, Venkat, we talked about not hiring a management company, and you can do it on your own. And sometimes the handiwork is needed and all that, and you can probably go and fix certain things. And I've seen it many times. And I was in New York, and I was renting a basement, and the owner always comes and fix a bathroom when something goes wrong and all that, and those kind of things, and you might be able to fix it. And one of the biggest things is, like, people spend money on, like, we actually did that calculation in the last episode. Hiring a management company usually costs like 8% from your rental income, and you will be able to, because the thing is, when you talk about that 400 to 500, 100 to 200, you have to factor that management company income,
Right.
especially
Yeah.
if you're out of state,
Yeah. Right. Right.
right? And so that's a big piece. And just wanted to add that piece, because you mentioned a good point, because when you say like a ballpark figure, 100 to 200, 200 to 400, 400 to 600, still you have to factor in that management company fee, and probably at
even
the end of
the even the vacancy, like you have to bring in a lot of things. Vacancy rate, normally, like 1%, 2% vacancy rate, you will able to figure out in that area, the market,
the year.
a vacancy rate, just by googling around your zip code and the vacancy rate. You may able to see some number there, right?
And yeah, and also at the end of the year, or January, like the property tax, and sometimes the HOA fee as a bulk, you have to pay like
HOP fee, you don't pay it with like, yeah, the amount that cash flow I was talking about is a net cash
it's
flow.
a net figure. That's what I was trying to get at. Yeah.
Right, right, right. Yeah, definitely. Like, but if you get anything, like if you wanted to be too conservative, you really want to invest in real estate, also don't keep that 8% as a strict rule, right? If you're getting 7%, but you may get, like, you are making too much money in your full-time job. You're getting 7% a year. What happens is, like, you take whatever spend, like, extra you're spending on this property, right, can be climbed on your tax return, and you may able to save some tax on your personal return if you file as a Schedule C.
Mm.
But most of them actually, if you have rental income, most of the people file as a Schedule E. It's like, just, I'm not a tax advisor. We are not a tax advisor, but this is just how people file. You can also file it as Schedule C as a business, like you have a business, right? Schedule C is like you have a business, you use that Schedule C along with
And
1040.
so you open up a good point, Venkatana. We've seen real estate investors don't have LLC set up for them. Are you saying that you can claim this as Schedule C, your rental income as Schedule C, only if you set up an LLC and receive the rental income?
Not necessarily. Yeah, you don't, like, you can have a sole proprietor, like a business, right? You don't need to have a registered business to have it. Schedule C for anybody, even a sole proprietor can use Schedule C. Even like if you are doing lawn mowing, you can use Schedule C.
So again, like Venkat said, there's a disclaimer right there. He's not a tax advisor, but still, if you have a tax accountant working for you, just check with him. Check with
Yeah,
him if
yeah.
you can claim this rental income under Schedule C, so you might be able to save some money right there. That's a good point, man.
Right. Yeah. Yeah. Definitely. And the overall, the 1% rule. Coming back to the 1% rule, is like we said, right? If the calculations make sense and you are getting close to 8% or about 8% return on your money, don't worry about the 1% rule. 1% rule, you can probably just, it's a easy way to figure out, oh, how much rent I should charge, but it's not going to be that much. It's also market rate. East Coast, West Coast, Midwest,
Yeah.
totally different. All rental.
Oh yeah, this 1% rule. Even it might be more than 1% in the West Coast in California kind
Right.
of areas. You will be able to rent it more than 1% from the selling price.
Yeah.
Yeah,
Yeah.
that's something that yeah, that's a good point too. It
Right. Yeah.
depends on the area that you live.
Right, exactly. Exactly. Yeah. Just, but at least you guys got some idea from what we discussed so far, and this is going to help you guys when you have a journey, real estate investment journey.
Yeah, thank you so much, Venkat. So basically, going back to the first point, 1% rule, it's not always feasible. Keep that in mind, and also keep in mind when you're next year around March, April, when you're filing your taxes, check with your tax accountant about Schedule C. So you might be able to save some bucks there. Thank you so much for watching, and until next time, it's goodbye from us.
Thank you, guys.